Insights. I'm Eric. Thanks for stopping by today. We're going to talk about inflation. I have a picture of a guy with his head, you know where, because we're kind of pointing out that if you don't think that inflation's peaked, I think that's what most people think where we're standing right now. So we're going to talk about that. We're going to talk about what the invisible hand thinks about inflation and where we're going, what's taken place and what might happen over the near term as well as longer term. I think longer term is pretty easy. We look at the bond market right here. The bond market is likely going to disappear in its current form. That might be a little while down the road. First, they have to take out the sovereign debt of the world rather than taking out the core economy of the United States. That doesn't go first, but eventually the invisible hand will target it. But before then, it's going to, it remains one of the only functioning bond markets in the world. It is not a very good place to park when inflation's rising, and even though there's capital flows that are coming to the United States, it's not really picking out the bond market. It's looking elsewhere. You can see it right here. The primary trends for most, and this is, I'm talking about the destruction of the public bond market into the sovereign debt market. There's also long-term corporate bonds right and high grade right here, and junk bonds. These are two different types of markets. But the public sector bond market is here, and they have a profile that's basically been in a primary downtrend for 18 months and 6 months, and they've got pretty sizable gains for that market. One thing is you stroll over, and we can see there's a lot of red and bolded numbers, and if we highlight the public treasury market here and here, you can see they apply the weekly cycles for the treasury bond market and the 10-year cycle, almost 3 standard deviations in terms of price. At 27 and 28 weeks, they're almost 1 standard deviation on the weekly time frame. In terms of the 10-year, we've been down for 18 months, a long time. That generates a time cycle of 3.4. The 11% gain on the short side is a 3.1% move. These are all fairly sizable moves, and they go back into, well, the bond market goes back to 1977. The 10-year is a little bit earlier than that. So we really track the bond market. That's the one I'm focusing on, the Treasury. The 30-year bond or 20-year bond and higher, long-dated paper on the public market or the public sector. It's not quite as high. It's 0.9 and minus 0.28. So at 6 months, it's still relatively early. What is probably a concern shorter term is right here. It's been down. It's generated a cycle of 3.1 and 1.1, but it's this 3.1. It's the size of this move that really needs a pause. It's the same type of pause that exists in the grain markets and some of the ag markets, that a rally would take place and hopefully it will take up the daily trend and then flip up the weekly trend and then turn everything lower. And it's probably going to do that perhaps as inflation doesn't come back down, but actually stops going up. You can have inflation that's chronic. It just doesn't get any worse. I don't know if that's any better. To say inflation's dead and say that we're doing this is kind of an overstatement. But it is due for a pause, and that's what I wanted to bring out. I mean, these trends are extended. The bond market needs to correct some of these excesses. The fact that probably too many people are bearish over the medium term probably means that the rally that's taking place in the daily market here has real potential to run until at least the weekly trends flipped up and turn this lower, and then resets the whole composite trend for the bond market so that this can continue entering a downtrend or continue down in markdown, which we consider to be a secular bear market. One thing I would point out is that the inflation, which there's different ways of measuring it. I really don't care what the CPI says. The CPI in general is not a very good, it's lagged, it's flawed. They manipulate it so much it's no longer reliable. So how we look at inflation, and this we usually talk about in the reports, the economy report and other things, but we're going to leave this one open since we're talking about inflation, and we're talking about what inflation is going to do over the near term, maybe the rest of 2022. And we can see the real-time measures of inflation that the computer uses. They're showing an inflation backdrop, but it's suggesting a possible transition because of these cycles. It's been up and it's so overextended, 32% above. That means that's really the real-time inflation expectation it's embedded into the bond market, and it's been like this for 20 21 months. That's a long time for an inflationary backdrop. It's due for a pause, and as it turns lower, that is a market then that would be primed for then a reset, which would what usually happens is you go into an inflation backdrop, then it falls off for a short period, collects some energy, gets brings in some more doubters, inflation's dead, and then it takes off again. If we can turn these cycles down from an inflationary backdrop to a non-inflationary one, get the numbers over here, the overall secular trend in an inflationary backdrop would be refreshed and likely continue higher. So that's the real risk, is that we don't have inflation head back down to zero. In fact, there's a reset, and you would come down, and then they would talk about, well, everything is normalizing. And then when everyone comes to believe everything's normalized, going to normalize again, it just comes back and bites everyone in the ass later. And that's usually how markets work. So I think we're going to keep an eye on this inflation trend. We're going to talk about it in the economy and stock report that's ongoing right now. It's located in the report page. I believe it's a series 1 report. So when this changes and flips off, we'll probably generate another update for that. But this is just the overall general backdrop. This would make sense that when we go to a non-inflationary backdrop, it just could be a pause, that the bond market would rally. We'll call it a bull trap, because people get bullish again and it traps them in, and then the thing goes back up and then comes back down. We reset down to triple down, and it really destroys everyone who turned bullish over the short term. So that's a logical event. I wouldn't buy the fact that everyone who's expecting inflation is full of it, or inflation to disappear, and those who expect inflation to continue are full of it. Those are just narratives, and if they don't have basis or foundation within the matrix or within the overall market intermarket trends, which we call the invisible hand and its intentions, we reveal that when we study that. It's just a narrative. It's just a narrative to sell to people. Perhaps it's a good narrative to sell while everybody votes up in November here in the United States or around the world. Says everything's looking okay, only to collapse afterwards. If you guys have any questions about the inflation setup, backdrop, or anything, or any comments, let us know. Thanks for watching. Keep an eye on this, and keep an eye on the economy and stock report.